This is Randy Finney with Right Side of the Chart, and this is a morning session update for Friday, March 13th, 2020. Scary number, but so far it's scaring the bears more than the bulls, but we'll see. I'll tell you, the day is very young as I do this video. Anything is possible. Anything can go today. So I just wanted to kind of do a quick video, share my thoughts, follow up yesterday. I told you yesterday is a point where I reached, the markets were, the odds for a bounce were going up substantially. As I said, the risk reward, for staying short or especially going short, started to really was starting to get stretched and diminished and wasn't just very favorable because you had these extreme overbought conditions. What happens, what's going on here is when nothing goes down forever. And like I said, we could have very well gapped down, had another night of lock limit down futures, gap down big. It could have gone either way, but it went to the upside today. I think the markets are up. QQQ was up at about 6.5% at the highs, or somewhere around there this morning, because what happened is the futures had started down after the close yesterday, but then turned around in reverse and just steadily went up overnight. So what happens is, again, it's about risk reward, and it's also about, it's more about technical conditions in the market than the fundamentals. The fundamentals have only continued to deteriorate. As I said yesterday, yesterday was more so a selling climax. You could talk about that, and I'll get to that in a second. It was what I labeled as a near-term a news climax, where the headlines just seemed to hit that kind of crescendo point yesterday with all that, starting with the travel ban the night before, everything else. And my wife told me Disney World shut down yesterday. I mean, that's crazy. We have the NHL now shutting down after their season, after the NBA. And the repercussions of that, of course, are enormous. So I want to just be very clear. The fundamental landscape has only continued to deteriorate, and I put the odds at more downside, considerably more downside in the coming days, weeks to months, as very, very high. So I very, very much maintain T2 is likely to be hit, and they'll probably add additional targets here. As I said yesterday, if you're an active trader, I thought the risk reward was not favorable and the odds for a bounce were good. And so we got that. So an active trader could have, recycled back in this morning on the pop. We could go up a little more. That's what I'm here to talk about, levels, but I doubt it. I don't think we're going to backfill that gap. That's the maximum bounce target would be back up there about that 195 level. Remember, we got one pop yesterday. But here's the thing. Right now, we are above support. And I made a case yesterday, and I'm going to get to stocks like Amazon. There's certain companies that people will start to step in and nibble at. But again, a lot of today is probably short covering, because what happens in the market is after such a big move in such a rapid shift in sentiment. I mean, look, it's hard. Other corrections, you had bulls that were diehard bulls, and there was, the corrections like back in 2018, and some of these along the way since then were technically induced. And you could make a case that there was just a blip in the economy, or the economic indicators may not even roll down. So what I'm getting at is, one could have made a valid argument, for the bull case, step in and buy the dip, and one could have maybe, of course, made the valid argument for the bear case. However, right now, I find it hard pressed for anybody to make a strongly, bullish case for the economy. I mean, at most, what you can do, and you could do this, and it is possible, say that how much. I'm just focused on QQQ here now. How much of that 25% drop into yesterday's lows has been priced in already? And that is what the market is trying to do. That's what the smartest people are. We're all trying to do, but especially institutional investors. Those, how much are companies' revenues? It's been a big thing here, shutting down all these events and people kind of tucking in their shell. A lot of companies shut down. But is it going to cause more than a 25% drop in revenues, in profitability, and all that? Because that's a big drop. 1/4. 25% is a pretty big number. So this is what the market's doing, and it'll hash it out. Again, I think there's more downside because, again, coronavirus is still ongoing. It's not, we're not turned the corner yet on this. And most people don't see that coming anytime soon. I listen, the smartest people out there saying, vaccines a long way away, and and again, it's a lot of companies are pulling in their shell, shutting down, keeping employees at home. And again, the ripple down effects from sporting events shutting down, what that has to everybody involved, the hotels, travel industry, everything else. So again, kind of rambling fundamentally. There's most likely more downside, but let's just talk technical levels, what to watch. And so this is actually a good thing, I think, today for the shorts, for those that are riding it out, because as I said, you can either try to be an active trader and be nimble and try to game these bounces. Yesterday the risk reward was unfavorable. Qs did close down below support, but the futures, and I'll get to that, went down, hit support in the overnight session and reversed. And so far we're back above that former first target was set above that 182.21 level. So here it is, the market's bounced, we're back above support. Here's the bounce target range, pretty much anywhere from about yesterday's highs up to about the 195 level I told you. And it's a big range. And I also made mention yesterday, and I'll say it again, this is where I like to kind of take a step back, let the dust settle for a little bit. I don't plan to trade as actively as much as before. I took a little time off this morning. My kids are on spring break, and I might take some time off this afternoon. Let's see how the markets close this week. Again, to put it in a nutshell, just, whether we bounce here in the near term or not, the odds, the charts, and everything that I'm looking at right now indicate we have more downside to come. And it's just a matter of, is this it for the bounce? Was this morning's pop it? Quite possibly, and then we go down, or is there more upside to come? And again, I think it's very limited. There's a lot of resistance here around that, up to that about 195 level. You got a couple of lows right here as well. So it's a pretty big bounce range in percentage terms, but it's not so big relative to the recent range. I keep using, I'll use the term relative a lot because everything is relative. When you have small candles here, a 2% move would have been huge back in the market. We didn't even have 1% swings. Now we're swinging 5-6% a day. So all the daily swings and these bounce targets again are all relative to the current expanded volatility. Speaking of volatility, one of the things that happens is you have the VIX. When the VIX does this, the VIX right now has reached levels not seen since the 2008 meltdown. Here's a chart of the VIX. So what I'm showing you here is there's the meltdown in 2008. Here's every high that we've had since then, and we're above that. Well, what does that mean? Does that mean we have to stop here? No. As I said last week or earlier this week, the VIX is not a bounded indicator. There is no floor and ceiling, although it does trade historically. We're going back decades here within a range. This is about the low end of the range right here. This was a period of unprecedented volatility. This was the high end of the range in recent years, even before that, even before the '08 meltdown, and we're above it now. What does that mean, Randy? If you're saying it can keep going up, but it's probably not going to go up. That's kind of what I'm saying for the near term. What the VIX is telling you, it's an indication, it's a measure of put calling versus put buying versus call buying. And so what happens when you have an excessive amount of people buying puts over calls? It tells you, number one, there's excessive bearishness. People think the market's going to go down, or they're trying to hedge their longs, as well as institutional investors. Don't get me wrong, there's a lot of institutions here. But what that does is it puts at least a temporary floor, and there's no set number to where that temporary floor comes in. But when everybody is short or everybody's hedged up, owns puts, those commercials, the ones that sell puts are typically the institutional investors, smart money, and they have to hedge against those positions. And what it does, it puts a temporary floor in the market. Again, things can break, so don't take that literal like, oh, Randy just said the market can't go down because put protection's here. It can, anything's possible, but it makes it much, much more difficult. So that's why I was talking about the risk reward not being favorable anymore yesterday, very favorable to remain short. And I talked about the risk of ETFs and staying short and being caught against big overnight gap up or gap against your position. So we'll get to the futures here in a second. I just wanted to make mention, this is what's going on. So I speak over and over about the fact I think the market's going lower in the coming days to week. weeks. I can't see anything in the fundamentals that I can spin as positive now. I did make mention, there are going to be people that step in and buy, and again, a lot of it's technically induced, but I mentioned Amazon yesterday is one that stands out among many. This company like Amazon, Netflix isn't fallen as much as it might normally have, because people are probably looking, okay, what companies uh, are either going to benefit from this or at least not get hit as hard. And so I used Amazon as an example yesterday, and it's up, and it's up. Now it was up quite a bit more. It's up a little over 3% now at support, and people are not going to stop shopping on Amazon. They might stop going to Macy's, for example, or Amazon owns a Whole Foods, but people also need groceries, and Whole Foods delivers. So all I'm trying to say is their business model is not as susceptible to, what's going on with the coronavirus and people staying at home as some other companies. And so you get that bounce. So it's a combination of a technically induced bounce and, with Amazon being at support in the markets. But again, the problem that Amazon faces, just about all other companies, is this. They are part of this. They are part of this, the S&P 500 and the NASDAQ 100, and they're in just about every large cap growth fund you can imagine. So when there's redemptions and people are selling, SPY and QQQ, they are not passive or actively managed mutual funds. What that means is a actively managed mutual fund or a hedge fund has a fund manager, and he may say, you know what, you can take my Amazon from me on the day I die. I'm not parting with that stock. I believe in it. And he or she may hold on to that and sell everything else. They may dump their Tesla. They may dump their Ford Motor Company. They may dump their Microsoft, whatever. But SPY and QQQ, they're machine driven. They have a certain allocation. Amazon's one of the top holdings. So when they get sold, when everyone's panicking and pulling it out of their S&P 500 index funds and QQQ, Amazon gets sold proportionally to what its weighting is. So that's why good companies go down in a sell-off like this, just so you can understand the whole supply-demand dynamics of it there. And all right, so let's go back to the charts. Kind of all over the place. Again, I'm mixing in fundamentals because that's important. What's going on right now? I'm talking about fundamentals a lot more than I usually do over the years when we're just letting the charts be our guide. All right, so technically, SPY had recovered that 258.55 level. Remember, yesterday it was well below it, and I didn't see any support really down to the 2018 lows. But we're back below it now by a bit. Again, today is a day I like to, as said it yesterday, I like to let the dust settle at this point after a big move. Trading's probably going to be choppy and erratic. So my plan is, I've already taken some time off today. This morning my kid's on spring break, and I'll probably take some more time off later today. Trader fatigue and burnout is something I've learned to manage over the years. It's been a great run so far last few weeks, and as I like to say, bulls make money, bears make money, but pigs get slaughtered. So when the charts aren't very clear, and you're going to have maybe like today some consolidation, plus we're heading into a weekend, so the markets are going to have to decide, or market participants, what do they take home? I'd like to see how the weekly candles close. They're certainly not going to be pretty, but let's see how the weekly candles close. I mentioned yesterday, SPY has this long-term trend line. It was trading below. Who knows? Maybe it snaps back up and gets on that trend line, and that's just one of many. QQQ. We're going to look at this today, guys. Again, by the way, we're going to go back. Let me go to the longest term. Let me look at my monthly charts. Here's QQQ on that monthly trend line. Here's a trend line on the Qs that defines the bull and bear market, the bull market. There's your trend line off the 2008 and 2009 lows. Well defined, plus that key 20-month exponential moving average. And look at that. We're close enough right now that it's anybody's game. If I was a betting man, and I'm going to say that 20-month is going to go, whether it's this month or not. But again, that doesn't finalize until the end of March, so we've got a little time there. And if you see, heading into the end of the month, which we probably will, it's going to be well below there. That's going to tell us with a pretty high probability that the QQQ has entered take that back. Technically speaking, it's entered a bear market. I spoke to that before. We're down 25%. The technical definitions have dropped 20% off the highs. But again, I labeled this bull market supersize is the one term I give it. And so the corrections are going to be larger than normal because the enormous run up was. And so 25%, like I said, you can call it a bear market. That's what the media is calling it right now. And we're probably going to see more downside. And it's probably going to be a bear market. But again, you can look at this and just eyeballing it. If you didn't have that 20% definition term, all you'd really be able to say is, oh, the trend is bullish and this is a correction within the trend. No different from this one right here or this one right here, which also that one took QQQ down over 25%, around 25%. Just QQQ back then, not the NDX, which it tracks, because QQQ is an ETF and it was prone to a flash crash. Surprising enough, we haven't seen any. I haven't seen any of the big large cap stocks that I'm aware of, or the index ETFs experience a flash crash recently with all the volatility that we've seen. So that's just interesting to note. It's been a while since we've seen one. We had a big one back in 2010 as well, not showing here on the chart. All right, let me get back to where I was going. So the monthly charts, the longest term charts still look bearish and indicate more downside to come. Let's go to futures real quick. And this is what happened last night. I had NQ. We had support here. We were holding yesterday at about 73.50, and then we went through it last night and almost a perfect tag. I had the next support level at 7,000, call it right around 7,000, along with that 76.4% Fibonacci retracement. If you're not familiar, you didn't catch that yesterday, that's the retracements off the major reaction low back in December of 2018 up to the recent high. So these are your Fib retracement levels. There was the 38.2, had our first reaction there. There was our 50%. Look at that perfect reaction on the 50% Fibonacci retracement level. And we even yesterday, remember, we did trade off there. We had a nice bounce intraday off the initial tag of that 61. You can't see it, it's buried there, the 61.8, and then boom, well, worked our way down. I've said this often. What I love about corrections, it's panic type markets, is that I've noticed that technical analysis seems to work at its finest. Traders at this, with everything changing, the fundamental landscape changing so rapidly, and everybody trying to parse the data and figure out what it's going to mean. And again, I've seen this in the past. It's my experience that technical analysis shines, whereas in a slow grinding bull market, it can be tough. We had a lot of good trades in the last year or so, but I've struggled with the broad markets, as I said, day after day when it was hitting all new time highs. There's nothing I can do but tell you, here's the levels to watch for a sell signal, what might trigger a short entry. But with the market at new highs, there's no overhead resistance, so there's not, and there's also that kind of, people are just in the buy the dip mode, the machines, the algos are just buying, going up. So therefore, at least on the broad market, there wasn't a lot of value I could add or provide on technical analysis other than the levels to watch. And we identified the short-term pullbacks and corrections along the way. And we had plenty of trades on individual stocks, commodities, and other sector ETFs, things like that. But this is where the technical analysis so far has shined. I think we've done a pretty good job of navigating the zigs and the zags so far. And again, here we are. We hit that level there. We bounced. More of a combination of, I think, the extreme oversold conditions, the extreme bearishness, coupled with the technicals. Market was going to bounce sooner or later, have an explosive short covering rally, short squeeze, and that's a good thing for the longer term bearish case. More shorts that are squeezed out, the more longs that believe the worst is over and it's safe to get back in the water and buy, the more it helps to clear out that excessive short interest, the excessive put to call buying, and then opens the door for a larger drop for the next wave down. And you can see it here, right there. We have a next target down here around, it's more of minor resistance, about 64.93. Then we're going to make a run at those 2018 lows, which a lot of people will be watching. And then, of course, I have, still my the bear market targets I've maintained for over a year now on QQQ and SPY, which are the highs back in the top of the trading range, or the highs back in 2015 to 2016. Then we broke above them right here. So it's about 115.35 on QQQ. Still about another 37% down. I'm not going to get there in a single day. And then SPY 212.52, and SPY only has about 18% to get there. So it tells me that QQQ has a lot more to fall. Now the way it works too is I have the major indexes here. So if SPY gets there first, which at the rate it's going, and it most likely will, that could change. Then we could bounce there, and then QQQ may reverse shy. So I watch both of these, and if if we continue on through there, I'll talk about it. We'll have to assess this bear market now, which we're in, as it develops, and I may certainly add other targets. These were just targets I was focused on for all throughout this period here, and we're certainly on the way there. This looks like a nice start. I don't mean to sound callous for those that I know I don't wish a bear market upon anybody, family members, friends, people I know, just everybody. I know it's not good for a lot of people out there. I know there's a lot of retirees or people close to retirement listening to my voice that have lost a lot of money lately. But I look at these are what it is. We can either bury our head in the sand, or I can bury my head in the sand, or look at an opportunity. Turn what to many people is devastating, and turn that into an opportunity and successfully navigate the next bear market down. It's what I did back in 2007, 2008, and actually profit and flourish from it and embrace it. Short selling is not an evil. You're going to hear about it soon. I promise you, especially with the president we have. Sooner than later, you're going to hear about it. Bans, talks about banning short selling, restricting it, maybe reeling in some of those short ETFs. And again, I don't want to, there's many reasons why I can tell you that would be a long-term net negative, not a good thing. Short selling has been around the financial markets for at least 100 years, and it serves its purpose. Let's just get back to the charts here and cover a few more things for you, and I'll wrap it up. Okay, yesterday the levels I was watching, I said to keep it very simple. You had these little recent trading ranges in SPY and QQQ. We had that pop had already happened earlier in the day, and that was that initial pop I was looking for, and then we popped it again on the open table. We're back inside of it, so that had the potential to do some more and maybe make a run up at the trend line. And if we do, we still could. But see, they smacked us back down. They smacked SPY back down to within that range here. Let me box it here, and I'll leave a box up. So that's the rough range right there. And little pop above there, back down within it, and the same thing holds. Now, being that we've come up at it again, failed, I'm favoring a break to the downside, and I'm favoring a break to the downside next week. Whether they rally today, and if they do, we're not far from it. That trend line would be your first resistance, and this is a big one right here. And I think if we get anywhere close, if you happen to pop this, we pop it in SPY and we run up there and we pop that trend line, and you get close to 273.40, I have to imagine the sellers are going to step in early. So many eyes will be on that gap that if we get anywhere close, we'll probably fade it. Probably not going to get there, is my guess. There's just the fundamentals are just too awful right now, and the technicals are pretty lousy. There it is on QQQ. So we popped it this morning, gap. They faded it back inside the channel or the trading range. And so the same thing really holds true as of yesterday. I talked about the potential for whipsaws. In fact, I could have made that box even a little smaller, going like that. There's a whipsaw to the downside, a whipsaw to the upside. That's kind of common when you have these big moves, especially with opening gaps. So we're really in that trading range. So to kind of keep it, again, at the risk of oversimplifying it, bullish if you break to the upside, bearish if you break it to the downside. If you break it to the upside is relatively limited, I believe, because there's significant resistance overhead. All this resistance right there, plus downtrend line resistance. And my preferred scenario is this. All right, one more chart, and that's ES right here. Or at least one more chart on the indexes. I believe I would have had this yesterday if I covered this or posted this chart. That is, let me change something here, get that going down there. 25.35. We went below it, but we were back tested. Actually, we went all the way up. It's been a round trip here. You look at that candle. We rallied all the way back to that 26.40.15. So again, these are levels I believe I had yesterday, and that's what there's an example of the market just really kind of hyper focused and trading off the technicals. So you can see, again, that skinny candle here. Let me move it back here. Boom. Rallied up, kissed the 2640 former support, now resistance, fell back down, trading right on that 2535 former support, now resistance. Again, you get above it, it's support. You get below it, it's resistance. Here it is. This is yesterday's chart. So there's those same levels. See 2540, 2535. These are all the levels on the ES, and again, that's what that was yesterday, and that's what it's trading to today. There's those same levels there. So as of now, as I'm doing the video, we're at resistance. So this is an objective time to short. If you want to act, whether you went long yesterday or just pulled out of your shorts and you plan to jump back in. I know I've been talking now for 25 minutes, but keep it simple. You could short here with a stop either above the top of the range, probably a safe bet the top of today's highs, but I think if you run back at them again, you might pop them and get up there. So I'd say keep it tight. Keep a stop above if you want to re-enter short on QQQ about that 187 level, about the top of this 60-minute candlestick right here, and then same thing for SPY. Because like I said, I think that's it for the pop. We had a quick, strong overnight pop in the futures. What that served to do is clear out short interest, ramp up a little, alleviate the excessive bearishness most likely. And then also we had pop at the open in the cash, the regular session. So Globex is the around-the-clock trading on the futures, but since that carried over this morning, there's SPY here, right here is the pre-market, and QQQ that caused all those stops to be popped on the shorts, and then boom, being faded so far. So there it is. And one last thing I'll talk on is we'll keep an eye on LQD. Like I said, I decided to revise the trading plan, pull the plug on that, and a good thing we did. We exited right here at the lows. It's bounced back, but look, it's back at resistance. That's that former second target was set just above the 120, 182 resistance. So we could actually recycle back in here short. And if it pops a little higher up there, that would even be a better, I don't think we'll get there, but if it does, even a better level there, 124.52. So I may add this one back as an active short trade today. Like I say, I'm trying to keep things light, let the dust settle today, but we're looking at objective levels, and this market moves fast. If you second guess an entry saying, darn it, I wish I would have went long this or short that, this market doesn't give you a lot of time to think because it's moving so fast. So thought process here, maybe take a cycle back into a starter short position about below that 121.82 level. Here we're at 121 right now roughly. And you could scale in. There's only to that next resistance level, there's only about 2.75% upside. And remember, my ultimately, I think LQD is coming at least to the bottom of this trading range here and may bust down below it. And that would be from where we're at now, downside of about 9%. So that's an attractive risk reward. Typically, I like our risk reward ratios of 3 to 1 or better, and as I just outlined, there's a little less than 3% upside to that target. Next resistance, you could have your stop somewhat above there, so you're risking less than 3% to make 9%, and that is, again, that's an attractive risk reward ratio. All right, guys, we'll wrap it up here, and I'll take a look at everything else. Like I say, I'll be around today and I'll look at the charts. I'll try to catch up. I know there's questions from the contact form, questions on the site, but I'm taking it easy today and keeping my trades light. And I will get back to, if I don't get back to you today, by the end of the day, I'll work over the weekend to get back to any questions, chart requests for gold members in the trading room, things like that. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.